Every bull market has a catchphrase. In 1999, it sounded like a punchline that turned into policy. We'll make it up in volume. Startups with no profits, barely any product, and a business model that boiled down to get eyeballs were valued higher than century-old blue chips that actually made things and shipped them. Venture term sheets rained from the sky. Analysts trained for the old economy waved away earnings as an outdated relic. Super Bowl ads turned sock puppets into stock pitches. The paradox that powered the party could be stated in one line. Companies losing money on every transaction were rewarded for doing more of them. If profit no longer mattered, what exactly were investors buying? The promise was that the internet would rewrite the laws of business. Distribution costs were collapsing. Information traveled at light speed. Network effects hinted at kingdoms where the first to scale would rule forever. If the technology felt like magic, then perhaps the arithmetic could be suspended long enough for the magic to become money. The dot-com bubble wasn't only a fever dream of banner ads and overnight millionaires. It was a system of incentives that made hype indistinguishable from performance. Once that loop clicked, profits optional, hype mandatory didn't feel dangerous. If a firm with no profits and almost no operating history could command that kind of mania, the message was simple. The web wasn't an academic sandbox. It was the new railroad, the next electricity. Capital sprinted toward anything with a dot-com suffix. Banks built a conveyor belt from Sand Hill Road to the NASDAQ. Go public early, scale later. A flywheel sketched on a napkin. Users lead to traffic. Traffic leads to ad dollars. Ad dollars buy more users. Could secure a roadshow. Network effects were real. The business discipline around them was not. Language changed first, as it always does when reality becomes negotiable. Revenue became run rate. Losses became customer acquisition. Market share turned into land grab. Blitz scaling, spend now to own tomorrow, wasn't a tactic. It was a creed. Metrics morphed to match the creed. Eyeballs and stickiness were treated like assets. Burn rate was rebranded as speed rather than risk. Lifetime value, inflated with heroic assumptions about behavior that had never been observed at scale, justified any cost to acquire. A retailer could lose money shipping bags of pet food across the country and still declare victory because the chart of monthly active users pointed northeast. A delivery service that bled on every order insisted that scale would cure unit economics once density improved. The spreadsheet always promised salvation 2 quarters away. The public markets did not merely accept this, they demanded it. Slow, the burn, and the judgment arrived in a single sentence. You dawn to get the internet. Mania needs oxygen. The late 1990s had plenty. Monetary policy eased after Asia's crisis and a hedge fund collapse. Liquidity searched for a story with a slope, steep enough to hide the risks beneath it. Technology supplied that slope. The IPO machine discovered a lucrative loop. Float a small number of shares for a hot brand, restrict supply, engineer a first-day pop, and let the headlines do the heavy lifting. Allocations rewarded insiders. Spectators saw triple-digit gains between breakfast and lunch. Each pop financed the next offering at a higher price. Price became marketing, marketing became price. The market's cheerleaders were not outside the tent. They were on the payroll. Research desks attached to underwriting banks poured gasoline on the narrative they were also selling. Strong buy notes emphasized total addressable markets and downplayed cash flows. One company after another was declared the Amazon of pets, groceries, furniture, auctions, travel. Fill in the blank, file the prospectus, ride the wave. Media outlets amplified the chorus because spectacle sells. Magazine covers anointed new economy rulers. Morning shows turned 20-something founders into cultural celebrities. When a sock puppet can raise brand awareness faster than a profit, and loss statement can raise cash, the game being played isn't investment. It's a popularity contest. Numbers had to cooperate. When they didn't, they were rearranged. Pro forma earnings excluded the costs required to conjure the illusion of growth. Stock-based compensation, marketing blitzes, restructuring charges. The more a company spent to chase scale, the better its adjusted profits appeared. Marketplaces booked the entire value of goods sold as revenue even if they kept only a small take rate, ballooning top lines without changing reality. Barter advertising, show my banner and I'll show yours, created revenue without cash, a magician's flourish that bled into financial statements. The signal investors needed, do you make money, was muffled under engineered noise. Measurement became marketing. Truth became optional. Temptation went retail. Online brokerages wired speculation into home offices and spare bedrooms. Day trading became an identity. Chat rooms offered DD that felt more impressive than filings ever could. Why model unit economics when the ticker tape promised daily riches to those who bought what everyone else was buying? Momentum masqueraded as merit. Reflexivity did the rest. Prices rose because they were rising. Rising prices validated the story. Validation attracted more capital, which pushed prices higher still. The loop tightened until there was no oxygen left for doubt. Question the theology, and the response arrived instantly. You just don't get it. Every party has a last song. For the dot-coms, the tone changed in early 2000. Rate hikes took the punch bowl off the table. Online advertising weakened as too many sites chased the same brands. Customer acquisition costs began to climb. Lockup periods expired and insiders sold, not because they suddenly hated the internet, but because valuation had outrun verification by a county mile. The calls were small at first. Companies beat their adjusted numbers but missed on cash. Inventories swelled at businesses that supposedly had no inventory risk. Profits later started to morph, without acknowledgement, into profits never, because the model only works when losing money grows faster. Then the gravity switch flipped. The NASDAQ peaked in March. What followed was not a stumble. It was a demonstration of a law that cannot be repealed. When a business has negative gross margins at scale, growth accelerates collapse. The dot bombs show the pattern in different costumes. One promised to ship heavy, low-margin goods anywhere with free delivery. The larger the basket, the larger the loss. Scale wasn't the cure, it was the disease. Another built a portal of massive traffic, then discovered that page views, pay the bills, when ad rates fall below the cost of acquiring them. A third played middleman for a category where the value captured by aggregation was too thin to survive once suppliers learned to sell direct. Each carried identical assumptions. Capital would stay cheap, growth would cover mistakes, and public markets would tolerate losses indefinitely because the internet made the rules. When the capital window shut, unit economics reappeared. Most models failed the first honest test they had ever taken. Cleanups expose more than bad math. They expose the way belief warps behavior across the system. Accounting scandals surfaced in corners of the market that had ridden the same tailwinds and cut the same corners. Regulators stepped in. Firewalls went up between investment banking and research to curb the most naked conflicts. Reporting rules tightened. Some reforms were blunt. Most were necessary. When a market runs on hype, detox hurts. The cultural hangover lasted for years. .com became a punchline. Engineers who once sprinted toward rocket ship equity settled for safer projects. Founders relearned an unfashionable habit called charge more than you spend. Yet the internet did not vanish. Bubbles don't only destroy, they also allocate. Capital burned in pursuit of fantasy still laid assets that real businesses later used. Dark fiber, strung along highways for absurd demand forecasts, carried the world's data. Data centers built for sites that never found profits housed the cloud. Tools honed to scale millions of customers under unrealistic timelines made it possible to scale tens of millions under realistic ones. The waste of one era became the foundation of the next. Survivors tended to share boring traits. They treated the web as a logistics machine, not a television channel. They built marketplaces with take rates that reflected real value and defended their positions with moats beyond coupon wars. They turned optionality into cash flow. The lesson remained as plain as an invoice. Hype can raise a bridge. Only discipline collects the toll. Patterns echo backward and forward. The script of 2000 reads like a remix of centuries. A monopoly promise in 1720 turned into a stock-for-story loop that finally imploded. Canal and railroad manias funded duplicative lines that bankrupted promoters, but left behind tracks a nation still uses. The Nifty 50 preached quality at any price until gravity remembered the bill. Tronics, radio, biotech. Each wave blended genuine breakthroughs with a willingness to forget that a business must eventually produce more cash than it consumes. The more recent cycles wrote new acronyms on the same set list. User growth at all costs. Sharing economies that shared losses with the public, blank check offerings that turned storytelling into a capital structure, crypto projects that assumed tokens could replace trust. Innovation changes the frontier. Human nature supplies the chorus. Underneath the poetry sits a simple machine. A thrilling story ignites demand for stock. A high stock price becomes a currency to pay employees, vendors, and acquisitions. That currency buys time for negative unit economics that would otherwise die under their own weight. The story attracts copycats and capital that drive up customer acquisition costs and compress margins. A small shock arrives. Rates, regulation, scandal, or saturation. Funding windows narrow. The model snaps back to cash reality. The majority cannot cross the bridge. Incentives reward participation at every step. Founders accumulate paper wealth. Bankers collect fees. The media harvests attention. Retail gains hope. When the music stops, the bill is divided among those left dancing. The obvious question follows. How do intelligent people fall for dumb math? The answer is less about greed than cognition. Extrapolation bias turns last quarter's growth into next decade's destiny. Social proof whispers that if everyone believes, they must be right. Career risk punishes dissent. It is safer to fail with the crowd than to be early against it. Narrative hunger craves simple arcs with inevitable triumphs. This time is different is the most comforting bedtime story capital has ever told itself. Even skeptics capitulate. The pain of underperforming a mania exceeds the fear of its end, right up to the end. There is an antidote, and it is unglamorous. Ask boring questions that do not trend on social media. On the 100th transaction, after the discounts, shipping, handling, fraud, service, and stock-based compensation, does the operation make money? If input costs rise, can pricing move without chasing away the best customers? How quickly does accounting revenue convert into bank account cash? If capital markets close for 18 months, does the business live on operating cash or die waiting for a down round? What moat protects the core economics from a better-funded copycat with a prettier app and a bigger coupon budget? When growth appears, is it being created by marketing spend that exists primarily to justify itself? Translate every promise into behavior. If the answers rely on belief rather than habits and incentives observed in the wild, the enterprise isn't a business. It's a marketing plan financed by strangers. The quiet heroes of the internet age rarely look like the posters on a dorm room wall. They are older businesses moved through new pipes. Retail with logistics superpowers. Advertising with auctions and measurable return. Software rented monthly with near zero distribution cost. The code didn't negate arithmetic, it magnified it. Margins improved because distribution costs melted and capacity scaled. Moats deepened because data learned, switching costs rose, and real networks formed around real utility. The language of 1999 said the web would break the rules. The reality of the winners said the web enforced them relentlessly. Does any of this still matter? Only if new stories sound familiar. When a pitch deck promises monetization later, translate to cannot monetize now. When every press release leans on adjusted metrics, ask what is being excluded and why those exclusions are permanent. When valuations rest on total addressable market slides rather than cash margin math, tighten the wallet. When marketing spend appears to create the very growth that is being used to justify, recognize the treadmill. When insiders dismiss arithmetic with, "You just don't get it," consider that understanding may be the problem they cannot solve. The dot-com era did not collapse because the internet was a fad. It collapsed because valuation outran verification and narrative replaced numbers. Profits were optional, hype was mandatory, and gravity was patient. The wreckage can look senseless in retrospect, but the lessons are tidy. Bubbles are the tuition paid for innovation. Sometimes the tuition is worth it because roads remain after the wreck. The bill is lowest for those who remember what a business truly is. A promise to produce cash, not someday on a slide, but predictably, with enough surplus to reward the risks taken. The patterns repeat because the participants repeat them. Newcomers arrive with energy and invention. Veterans arrive with caution and capital. The newcomers tell a story strong enough to pull the veterans forward. The veterans tell themselves they can exit before the music stops. Together, they stretch the rubber band beyond its strength. Then the tiny rip appears. Maybe it's a missed quarter hidden behind an upbeat headline. Maybe it's a rate hike that removes one layer of sugar from the punch. Maybe it's a competitor willing to sell $1 for 95 cents faster. The rip becomes a tear. The tear becomes the new truth. Enthusiasm curdles into doubt, and doubt takes away the oxygen hype requires to burn. The same desks that blessed strong buy discover neutral. The same outlets that crowned kings discover cautionary tales. The sock puppet goes to a museum of advertising. The bill makes the rounds. There's a sober kind of optimism worth holding on to. The internet did rewrite the world. It shortened distances, widened markets, created industries, and democratized creation. It also punished indiscipline without mercy. The lesson is not to fear every boom. It is to separate breakthrough from make-believe using questions that outlast fashion. The winners of tomorrow will use code to make margins fatter, balance sheets stronger, and moats wider. They will measure value the way a merchant from any century would. Money in, money out, surplus left over, repeatable at scale. They may talk about network effects and flywheels and AI because those things are real. They will still pass the only test that matters. Does the math clear when the music stops? Every cycle promises that profits can be postponed as long as the story compels enough believers. Every cycle ends when cash demands its vote. The dot-com scene played that script in bright neon, with a soundtrack loud enough for a generation to hear. The next scene will arrive in subtler colors and new acronyms. It will whisper the same temptations and punish the same mistakes. Curiosity about new technology is healthy. Cruelty toward bad arithmetic is survival. Own the pipes, not the parade floats. Allocate small to the dreamers and large to the compounding machines. Translate narrative into numbers before the numbers translate hope into lessons. If this gave a new perspective, hit subscribe. History has the answers. Keep looking.